How's it going, everyone? My name's Sam. I'm coming over from the channel My Financial Friend. I come on TipRanks once a week just to cover some different growth stocks. Now, there are two stocks we have to cover here today. We're going to take a look at last week's stock, and we have to take a look at another huge growth stock that blew out expectations, and something that a lot of people might not know about the company, which is really interesting and could definitely change your perspective on it. So we're going to take a look at Facebook and at Google here today. If you guys don't mind, hitting the like button though before we get started. I really appreciate that. It does help out the channel. Also, hit subscribe if you haven't done that already. We're on the road to 25,000 subscribers here on TipRanks. Also, if you like any of the tools that you see here today, you can check out the links underneath the video to get access to those tools. So Facebook actually fell about 4% after earnings, but they blew out expectations. So here is what happened. Earnings per share was actually about 3.61 versus about $3 expected. Revenue was 29.1 billion versus 27.9 billion expected. Monthly active users was right on pace. Now you might be asking yourself, okay, if that's the case, why did they fall down in price after their earnings? Well, they didn't give any forward guidance, and they also said that they thought that maybe their growth would actually stop accelerating at such a fast rate, which is understandable. Their ad revenue rose 56% year over year. They grew revenue so quickly, and their earnings per share is the highest it's ever been. So they're just saying, not that they're going to earn less next year or in the future, but they said that they're not going to accelerate at this rate, which I think makes sense. I mean, we're coming out of a pandemic where no one could do anything besides sit at home, essentially, right? For a lot of people, they just had to sit at home. So we have a lot of people actually raising price targets after this, even though the price is falling down. We have a lot of analysts raising price targets. So you can see here, Facebook was raised from 375 to 405 at Oppenheimer. Facebook price target increased from 460 up to 500 at JP Morgan. They went from 390 up to 450. A lot of these different analysts are just raising expectations because they had such a great earnings. Now we'll take a look at it and break it down, what this means for the company and what forward growth will look like in a minute here. But let's take a look at Google here too. So Google has had something similar. We've had a lot of people raising expectations. If you look over here, they actually blew out expectations also. So they actually reported nearly $28 worth of earnings per share, about 27.26, and they only had about 19.24 estimated. So I had talked about this either on my channel, I believe it was on my channel, not TipRanks, but I had talked about how they consistently have been beating expectations. The orange here is what they actually earned, the blue's what's expected. You can see that they were under for one quarter there and then one quarter back here, but the last 4 quarters before this quarter even, so now the last 5 quarters, they beat expectations pretty handily. So they had their expectations raised for next quarter, but still below what they've been for the last 2 quarters and almost the last 3 quarters. Now, something that's very fascinating about Alphabet and about Google is actually YouTube. So obviously you're watching YouTube right now. YouTube is bringing in as much revenue as Netflix. That's kind of crazy once you start thinking about it. They had an 84% rise in ad sales, and they had $7 billion in revenue. Netflix had 7.3. Also, YouTube is growing at 4 times the clip of the video streaming sales, putting up nearly as much ad revenue in 3 months as it did in all of 2020. Obviously, a lot of people thought that YouTube was going to get big, but the fact is it's growing much quicker than people realize, and it's just going to continue that way in my mind. It's like the people's platform as opposed to Netflix, right? So I think people will continue to watch it because of the fact that, hey, this is the best that everyone has to offer, right? If you want to make content, you make it on YouTube. So that is my opinion, of course, but I was very excited to see this. You can see the earnings per share soared 62% year over year. The revenue soared 62%, earnings per share 169%. Now, let's take a look at some of the numbers here. Let's break down earnings per share and stuff like that based on run rate. So the run rate earnings per share on Facebook is 14.44. This is just last quarter's earnings per share multiplied by 4. So hopefully it's higher than this over time, right? We wouldn't like to see earnings per share stay stagnant for 4 months or for 4 quarters. And then Google is the same, 110.76. Right now, the price per share on Facebook is roughly around $3.60, Google $27.25. That puts them both under a 25 forward PE run rate. Now, of course, I think personally that they will probably grow earnings per share. There might be a couple quarters that come down a little bit, but I would guess that their forward PE would actually be a little bit lower because they would have more earnings. So year over year growth, 56%, 62%. This is their year over year growth in revenue. So they're growing really quickly. Now, if we assume that their profit margin stays the same, so they grow, let's say they grow 30%. So they grow 30% over 5 years, and they're not any more profitable, which would be rare, right? Because what we just saw back here was that they had revenue soar 62% and then earnings per share went up 169 because obviously there are some expenses that are just flat, employees, CapEx, buildings, and then more money comes in, it goes straight to the bottom line. But we're going to assume, hey, the profitability stays the same, or the profitability moves up in line with the revenue, which obviously isn't right. But we're going to assume 30% for 5 years. So their earnings per share goes up 30% over 5 years. That would mean that Facebook would have earnings per share of $53.6. Then Google, $411. That would put them at a 5-year forward PE ratio of 6.7 on Facebook and 6.6 on Google. One other thing that I want to point out is the cash after all expenses. Both of them have very strong balance sheets. They do have long-term liabilities, short-term liabilities, but they have more cash than they need. And the thing is, at such large numbers, it becomes a little less important to have multiples. For example, a lot of the time people will look for a 1 current ratio, which is that the current assets over the current liabilities equals 1. 2 is even better. But the fact is, you wouldn't want to probably have $100 or $200 billion sitting in cash if you're one of these companies. If you have, let's say they have $200 billion in cash and $100 billion in liabilities, that might not make as much sense as a company with maybe 50 million in debt and 100 million in cash, because the fact is they don't need that amount of money necessarily, because 32 billion and 38 billion is still a ton of cash. It can help them acquire companies. It can help them if times get rough. There are all different things that they can do with 30 billion in cash. So that is what these two companies look like. You can see here the estimates for both these companies, what people expect them to be at in a year. We can see the average price target is $3,150 on Google. And then also we can take a look at Facebook. It's going up too, obviously, because of all these different analysts. It's about 415. So thank you guys so much for watching. I really appreciate it. If you guys want links to these different tools, you can check out underneath the video. And definitely hit subscribe, hit the like button. If you guys want information for my channel, it's underneath the video too. Thank you guys, and I will see you in the next video. Bye.